This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest episode of the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, and this week I'm joined by Laura. Laura, it feels like it's been about 10 years since we've done a podcast together. Where have you been?
I actually don't know where I have been, but it's so nice to be back. And we're actually doing this in person for once, which is nice.
Living the modern world.
And this week, we've got lots of stuff that we're going to be digging into. So we'll, of course, be covering that latest sell-off in US tech stocks. And Dan's also going to be looking at WHSmith's potential sale of its UK business and those rumours about drinks giant Diageo selling Guinness. And I'll be tackling a topic that is frustrating taxpayers across the UK, long HMRC call wait times, and some people facing huge fines simply because they can't get through.
Now, we've got Tom Sieber from Shares Magazine on the show. He's going to be talking about attending AGM in person and why it's so important for companies to engage with their investors. And I'll be chatting to Chris Tennant, who is the co-portfolio manager of Fidelity Emerging Markets. Now, we'll be chatting about what Donald Trump's influence is on emerging markets, why you might want some exposure to this area in your ISA or pension, and what the future holds for China.
So lots to get through, but let's dive in and talk about that recent sell-off in US tech stocks. So we've seen a bit of a correction in some of the biggest names. I'm thinking Apple, Microsoft, after months and months of strong gains. So just in case anyone hasn't heard, what's caused this sell-off in markets?
Well, we've got this Chinese sort of AI company called DeepSeek. Seems to have come out of nowhere. Essentially came out and said that they've got an AI model, AI system that essentially is a lot cheaper to run than the existing stuff. Normally you think, okay, fine, that's interesting. It's a sort of a what you might expect in a market, competitive dynamics. There's always someone else comes along and does something cheaper. But here, because you've had companies around the world, particularly some of these really big tech companies, they've been investing billions of dollars in AI infrastructure. Now along comes obviously an alternative that looks really cheaper. So investors going, well, wow, what does this mean for the sort of the existing AI winners? So we saw shares like NVIDIA, the chip company, fell 15, 16% in a day. Pretty much anything linked with AI had a very miserable time. And people just like go, okay, what does this really mean? What is DeepSeek? What is it doing? Interestingly, you then had a reaction from people like Microsoft saying, well, actually, the cheaper that it becomes to run AI systems actually could be better. That means more people can do it. So we might see, it might be good longer term for this big revolution that everyone's been talking about, this big AI revolution. So the following day, we saw lots of tech share prices jump back up again. Indeed, we had actually a quick look to see what the trends were for AJ Bell customers. And we saw NVIDIA obviously it was really badly hit, but the following day there was way more demand for people wanting to buy those shares on the AJ Bell platform than the sellers. And so now we're recording this just as the big tech companies are starting to report their earnings. So next week, we'll give you a roundup of exactly what they were saying. But I think overall, it just means that we've had a market where everyone was thought, anything to do with AI, lots of people assuming that they're just surefire winners, going to do. Competition is now emerging, and this is what we should expect, and it's really healthy. With just lots of unknowns about the impact of it. So overall, I think it's been a pretty testing time for investors, obviously, if they've got big exposure to the US, and I think lots of people do. But it's quite encouraging to see the market settle down in sort of subsequent days. I think it helps to repair sentiment quite quickly. And I think there was always that danger that US tech stocks are looking really expensive. And could that, what was the trigger for a sustained market correction? And thankfully, this is not it.
And it's interesting, I think you made a good point there with lots of people have exposure to the US and then particularly to this Magnificent Seven group of US tech companies. And that's because they've seen such big share price growth in recent years. So now they make up a huge chunk of the US market and in turn probably quite a lot of people's portfolios. So it is probably also quite a good wake-up call of that old message of diversification and making sure that you are spreading your money around and you're not too concentrated in one area, isn't it?
Absolutely. I always think that, if you're looking at building an investment portfolio, have some boring stuff in there as well as those exciting things, because you never know where they might come in vogue. Surprise, surprise, when we saw the market sell off, the stuff that was in demand was things like, tobacco manufacturers and drinks companies. We're all going to reach for a can of fizzy drink no matter what sort of going on in the world, whether it's AI's in sort of trend or not. And so, we talk about diversification a lot on the podcast. So I think it's really important. Don't just put all your money in what you think is going to be the winners. Spread it around, because you should expect something in your portfolio to be out of favor versus something else. Because if it was all moving in unison, that's fine when the times are good, but you don't want everything moving in unison when everything is looking a bit bleaker.
So a message I tried to give my husband the other night when he was talking about his investment portfolio. Thrilling chats in our house. But exactly that point of if everything is going up at the same time, then you're probably not very well diversified. But anyone who wants a full written explainer of what happened can check out the AJ Bell website. If you head to the investment articles section, there's an explainer of how investors can protect their portfolios, but also a bit more detail on what happened in markets. So let's look elsewhere then. WHSmith, Dan, there's news that it might sell its UK business.
This is troubling on many levels, mainly because my favourite Twitter account is the one that tracks the appalling carpets that WHSmiths have got in their shops, with lots of pictures of like gaffer tape holding them together, and then like books piled up in the corner and stuff. And I fear that if we're going to get a new owner for WHSmiths, that this Twitter account has come to an end. But WHSmiths is for the average person, they go, okay, what is it? It sells stationery books and the Christmas Radio Times on the high street. In reality, the bulk of their profits come from shops in airports and train stations around the world. This is not simply just a UK story. They've kept the UK high street stores going for years. They've done as little as possible to make them look smart, hence why they are the butt of many jokes about how shambolic the stores are. But they've been quite clever. They make money from them, generates lots of cash. Obviously, that helps pay things like the dividend and all the sort of the wages of the company and stuff. But their growth is coming from these travel hubs. They've now reached the point where they're saying, well, we're going to sell the UK operations. We'll be left just with the travel stuff. And it's kind of like we've been waiting for this moment for a long time. It's interesting why they've done it now. You've got quite a bleak outlook for the UK retail sector this year. The prospect of higher employer national insurance contributions, the increase in the national living wage, extra costs linked to employment rights, all these are pushing up costs for retailers. They're just going to pass on those costs to the customer. Now, the consumer is pretty fragile at best at the moment anyway. This outlook from April, when these things come into power, it's not great. I'm wondering why on earth why didn't WHSmith either do this last year when things were looking okay? Why have they done it now? Or maybe it's because actually there's speculation they might get 100 million, which is in the bigger scheme of things is for a much bigger company like this, it's probably not much. They probably just want to draw a line underneath it. But so of course that leaves a speculation who's going to want to buy 500 stores on the high street. I don't think there's going to be a big list of people, but there are some, there's lots of speculation. There seems to be, a good handful, 4 or 5 companies that could potentially come in and do it. So yeah, definitely one to watch. So if you'll probably see the first thing they'll do is to replace the carpets.
And that Twitter account will be deleted, a personal loss for you, Dan. And then there's also Diageo. That was the other big story in markets this week. So rumours were swirling about the company potentially selling Guinness, but Diageo, they've denied it, right?
Yeah, they've denied it. But, I guess you could look at it in 2 ways. One is that they might not be selling it today. Well, what about next week? Or, what about in 6 months' time or something? Diageo has gone through quite a difficult few years. There seems to be the management taking their eye off the ball. We've discussed it quite a few times on the podcast before. They've had some stock issues in sort of South America and stuff. Generally, as a business, their focus is on spirits. I always got the impression that Guinness was always become an afterthought for the business. But over Christmas, we had all these stories in the paper about the pubs are running short of Guinness. The skeptic in me thought, okay, that's, Guinness has got a reputation of being absolutely brilliant at marketing. I don't even remember the advert years ago where they had the sort of the horses running in the sea.
Yes, I loved them.
And they were brilliant. And I wonder if someone just had a smart idea like, let's tell everyone we're short of Guinness, create this buzz. Everyone's talking about it. It's managed to stop the share price falling. It's pushed the share price back up because everyone's saying, okay, Guinness is relevant again now. So actually, the timing is kind of perfect if they wanted to sell this business. What a brand! This brand is huge, absolutely huge. And imagine if it was bought by someone who cared a lot about it and rejuvenated this brand. I think there could be a lot of people interested in it. So, yes, we had this speculation quickly shot down by Diageo. Now, Diageo issues its results in a few days. I think we get it next week. And so clearly everyone's going to be asked this question, what are you going to do? Are you going to sell it? Because I think, we've got this trend for companies to sell stuff at the moment. Slim down, focus on what you do best. Don't try to spread yourselves too thinly. So, if they come out with this news, it'd be really interesting, but, it wouldn't surprise me. It would just fit strategically with what many businesses are doing at the moment.
Yeah, and I feel like someone would snap it up. Have you seen the big social media trend for splitting the G?
No.
I knew I was going to be teaching you something here. So this is where you get a Guinness and you drink the Guinness, and your first, essentially like mouthful of Guinness, you have to get it down to a level where it splits, lands exactly halfway through the Guinness sign.
Oh, okay.
And so it's like this big social media trend, and that's partly why Guinness has become really popular, as well as, around Christmas people drink it more. But yeah, it's become, you just got to go viral on social media if you want to up the price of your business before you're selling it off. Now, slightly less fun, let's talk about HMRC and the chaos that taxpayers are facing. So a recent report highlighted that people are waiting hours to get through to HMRC if they even manage to at all and are not just hung up on. And for some, that's resulting in fines because they can't resolve the tax issues in time.
I think that is pretty frustrating, isn't it? Particularly time of year where people are trying to sort of file their self-assessment returns before the 31st of January deadline. So what's actually causing all these delays then?
So essentially, we've had a few different things that have played into this. A big increase in the number of taxpayers overall, and then also the number of people that need to fill out a self-assessment tax return. So because certain tax allowances either have been frozen or have been cut, if we think about things like the dividend allowance, capital gains tax, some of those allowances have been cut, which means that more people now need to pay tax and more people need to fill in a self-assessment tax return to declare that tax. So you've got this huge influx of people who are often filing a tax return for the first time, finding it quite complicated. The self-assessment tax return itself has got longer and more complicated for people to fill in. At the same time, you have got a very underfunded HMRC, which doesn't have enough staff and resources to man those phone lines. So what you end up with is lots of people calling a phone line with not enough people answering it. Now, HMRC says that it can divert lots of people to digital help, so go to their website and find some guides and some information there. But obviously, if you're filling out your self-assessment tax return for the first time by yourself, you're not quite sure what you're doing, and you also don't want to mess up your return and get the tax wrong and get fined. Lots of people want to call and get that reassurance and get that help on the phone, and they're just finding that they cannot get through. And quite often what HMRC will do is they will lead people through and say, what's your query about? And then they will say, you can deal with this online, and cut off the call, which must be so frustrating for people that have waited on hold for a long time and just want to get to an actual human to speak to get some support.
Now, is there a certain type of person who this is causing the most problems to?
So obviously, self-employed people are much will have to fill out a self-assessment tax return. So most people who are on PAYE and don't have any other income from either investments or other sources wouldn't need to do a self-assessment, although definitely check the criteria online on the HMRC website to see whether you do need to. But obviously for self-employed people, they need to do it. And if they're not employing an accountant and having to do it themselves, they might have questions that they want to put to HMRC and get answers. So it's particularly impacting those. What we also see is a big increase in the number of people being hit with penalties, either for late filing, so not filing by that deadline, or by not paying their tax on time and then having to pay interest on that money. Now, if you can't get through to HMRC on the phone to ask you a question about your tax return, you might then not want to file it in time with potentially incorrect information. So what we're seeing is people being fined because they can't get through.
Sounds like a job for ChatGPT to ask the system what to do. So I'm sure that HMRC is not intending to invest more money in more call center agents, isn't it? The direction of travel must be more automated services.
Yeah, I think more bots, more kind of self-help things. They've also just not been given more money by government, obviously, for them to be able to hire more people in their call centre. They need more money. They need more budget from the government to be able to hire those people. And that hasn't really been coming through. So it's tricky to see how this is going to end. The number of taxpayers isn't dropping. The resources that HMRC is getting isn't increasing. So it's tricky to see how this is going to improve anytime soon.
I mean, it must be incredibly frustrating for anyone who's experienced it. I wonder if the more we talk about it, the more publicity this is getting, putting the spotlight, will that actually encourage the greater budget to be allocated to this? Probably not.
You would hope so. You would hope that, people personally being fined. And I saw someone talking this week about, if HMRC was a private company and it was operating this way, the headlines would be filled with it and it would be being, pulled up in front of MPs and the government. But yeah, we can only hope that shining more of a light on it will help and will improve it. Right, so let's switch turns again. So earlier this week, Dan had a chat with Tom Sieber of Shares Magazine about what it's like to attend an annual shareholder meeting. So it's not something every investor gets the chance to do, and they can be interesting events. So let's take a listen to that interview now.
So Tom is with us. Tom from Shares Magazine. How are you?
I'm well, thank you. Yeah, how are you?
All right, thank you very much. Now, I see in the latest issue of Shares Magazine, there's a very interesting article about going to a shareholder meeting. So an AGM stands for an annual general meeting. I think lots of people listening to this podcast will be aware that companies hold these. The big ones are typically popular with people. Certainly over the years, they used to, some of the really big names used to give you a nice little spread, good food and drink. I always used to chuckle.
Freebies.
Yeah, conversations with investors, and they could reel off who has the best quality sort of food and drink. But these days, I think there's a general push for sort of even smaller companies to try and encourage investors to either come along or perhaps go look online. But one of your reporters has been off in person to an event. It's slightly different from perhaps what people will know. So do you want to tell us what's been going on there?
Absolutely, yeah. So as well as covering sort of some of the bigger stories affecting the markets over the last week or so in this week's magazine, we've also got an article on a slightly more kind of left field name, I guess. It's an AIM quoted company called SRT Marine Systems. So I doubt many of our listeners will necessarily be familiar with it, but it digitizes data for people like coast guards, security agencies, fishery regulators, other boat users, basically people operating in the marine space, to help them kind of do what they need to do, go about their business in a safe way. My esteemed deputy, Ian Conway, is a shareholder of SRT, and he took the opportunity to attend the AGM in person. But as well as attending the AGM, the meeting itself, the company also threw open the doors of its headquarters in a little village basically near Bath, so people could learn more about the business. And from what sort of Ian says in the article, and obviously the conversation that I had with him when he was pitching it, it was very well attended. There were a large number of people who turned up, despite the fact that this isn't necessarily an easy to reach location. It's a little bit out in the sticks. So there's clearly interest there from people about finding out more about what what the business does.
So I think when you go to these AGMs, they tend to be sort of, stick your hand up. Do you want to vote in favour of, how much money we should pay the directors? What sort of, how many shares can we buy back in a year? So it's quite sort of dry administrative stuff, but equally stuff that does matter. I think being able to see what a company does in person, whether that's a factory or demonstrations of technology and stuff, it really makes such a difference, doesn't it? So what was Ian's highlights that he saw there?
So 100%, yeah. I mean, I think for Ian himself, he knew quite a lot about the business and what it did, but he did get to see sort of how the products work in person. I think he was really interested to see who else might be there, and there were a lot of other shareholders. Interestingly, he felt like he'd been invested in the story for a while, but a lot of them had been around for a fair bit longer than he had. And you're right. I mean, the basics of an AGM can be a bit humdrum. They are important, as you say, but I think in this case there was no controversy around any of the resolutions. It was, a show of hands, and obviously the people who had voted by proxy, that weren't attending but had voted at the AGM, also kind of that their votes were counted as well. But at the same time, I think, as well as being, this is a slightly unusual case in where a company has allowed people in to sort of see what they do at the same time. But, it is also typically an opportunity, if you do attend in person, to quiz the management. The chief executive was on hand to sort of talk about the business and what they're trying to achieve. So, I think at a time when, we hear a lot about how AIM's having a difficult time, very much out of favour potentially with at least some investors. I think, this kind of thing is to be applauded. It's good to see a company looking to engage with shareholders. And interestingly, SRT had opened this up to anybody, certainly the open day element of it. You didn't have to be a shareholder to attend. So I think, maybe more companies could take a leaf out of SRT's book and look to really engage with investors. Because as you point out, being able to see it in person and understand what a company does makes a huge difference, is a real advantage.
Because I certainly talk to investors and companies in the past about just their thoughts about AGMs and trying to encourage more people to get involved. There was a suggestion that actually, should all companies have an online AGM so everyone can watch it? And I thought this sounded like a pretty good idea, but the pushback was that they could choose which questions to ask, but if you're there in person, you can see the whites of the eyes. You can't cherry pick stuff. So in a way, you can hold management a bit more to account, where if you're doing it online, you can hide behind a screen. But I think the idea of getting more people involved via a demonstration of what they're doing, perhaps that's what we need. I certainly remember years ago, someone said to me they went to a Domino's Pizza AGM. He said that there was more pizzas laid out on the table than there were people attending. I thought that. That's incredible, isn't it? So, but generally, I think what we'd love to do is to regular listeners to this podcast, please get in touch. Give us your thoughts. Have you been to an AGM? Was it useful? How do you think the system could potentially change? And if there are some interesting stuff in there, we might revisit this topic on a sort of future program. So drop us an email. It's podcast@ajbell.co.uk.
Yeah, I think that's an excellent idea. And as you were saying about the kind of online element, it doesn't have to be an either or. You could obviously host people in person, but also offer an online element because, with the best will in the world, people are busy. They might not have the time, the ability to go to AGMs in person. But I think this idea of investors being engaged, understanding that by owning shares, they're a part owner of the business. And, it's important that they engage with the companies they're invested in.
So thanks again for Tom coming on to show, talk about shareholder meetings. So let's bring on our final guests. A couple of days ago, I had the chance to speak with Chris Tennant, who's co-portfolio manager of Fidelity Emerging Markets. So we discussed some really interesting stuff, including obviously what's going on with Donald Trump and how that impacts what's going with Asia, emerging markets more generally. So let's listen to what Chris had to say.
Well, I'm really pleased to be joined today by Chris Tennant from the Fidelity Emerging Markets Trust. So, Chris, thanks ever so much for joining us. I wondered if we could sort of perhaps start the discussion by maybe perhaps you could explain why someone might want to sort of consider having emerging markets exposure in their portfolio. Because I think, obviously, if you look at sort of the GDP forecast for a lot of countries classified as emerging markets, they seem pretty much faster than developed countries. And is that sort of the key to why you're interested here? Because does that imply fast corporate earnings growth, or is there sort of another reason why perhaps emerging markets is something to look at?
Absolutely, thanks, Dan, for having me. Yeah, so high growth rates is definitely part of it, but it's certainly not the only reason for investing in emerging markets. And faster rates of GDP growth don't always necessarily translate into corporate earnings growth and stock market performance. So you have to consider a number of different factors. So the first other sort of reason for investing in emerging markets is the very strong sort of fiscal backdrop that we see today. And so whilst other countries in the world during COVID announced large stimulus measures, this wasn't typically something that we saw in emerging markets. And so relative to developed markets, the budget balance in a lot of emerging market countries is the strongest it's been. The next point I would point to would be around demographics. It's increasingly a headwind for developed market economies, aging populations, and the impacts that has on their economies. You have quite the opposite in emerging markets, where you still have young and growing working age populations, and these young workers are starting to spend money, and so that is a big driver for consumption across emerging markets. And a lot of emerging markets are transitioning from investment-led economies to consumption-led economies. Another point that I would mention would be around valuation. So notably, the US market is trading at extremely sort of elevated earnings multiples relative to history after a very sort of strong period for the stock market, and quite the opposite is true for emerging market economies, where these markets have been out of favor for a long time, and we're seeing valuation levels for a lot of countries in emerging markets at quite depressed levels. There are a couple of exceptions. Taiwan and India are also fairly expensive markets, but by and large, emerging market valuations are at quite depressed levels. And then the final point I would mention would just be around what has driven a lot of the excitement in the US market has been around AI, and NVIDIA being the sort of poster child of that sort of AI boom. This wouldn't exist without emerging markets, and the fabrication supply chain for the sort of semiconductors that are used to facilitate AI are generally based in Asia and Taiwan in particular. And so you also have a lot of AI beneficiaries in emerging markets as well.
As a fund manager, how do you go about building emerging markets portfolio? Is the starting point to pick sort of the companies you're interested in, or do you look at a country and then you sort of narrow it down to see which sort of stocks are available in those regions?
Yeah, so there are different ways that people do it. At Fidelity, we're very much a bottom-up house, and so we have I think one of the largest research teams out there, particularly for emerging markets, and so we have a large sort of resource available to look at the markets at the company level, and so we're really looking company by company for the best investment opportunities, and so it's very much a bottom-up approach in that regard. And then it's important to sort of take into consideration where that company might be based, and so if it's in a country where the sort of macro imbalances mean that you might have FX pressures, you'd have a higher sort of hurdle rate for companies that are in those types of country. And so we translate everything back into an expected dollar total return for every company that we're looking to invest in, and that's how we sort of rank those investment opportunities that are available to us. And then after that, after we've identified that sort of selection of best stocks, the stocks with the best risk reward, we'll look to construct a portfolio that has got exposure across all of the sort of the major regions in emerging markets, so that we don't take a bet on one particular country that's too big. And so we try and build a diversified portfolio of those most attractive investment opportunities.
I mean, one of the things I always like doing is you get an emerging market fund or investment trust, and you take a look at the portfolio. I think but for quite a lot of people, they probably wouldn't recognize a lot of the names in the portfolio. I was having a look at yours. I mean, there's some like Samsung Electronics that perhaps is well known, but things like Make My Trip, I'm certainly not familiar with. I wondered if you could just sort of take maybe a couple of examples and explain what's interesting about those sort of stocks.
Absolutely. So Make My Trip is an online travel agency in India. It's got a fairly dominant market share position, controlling over half the market. And so a close sort of business that listeners might have heard of would be Booking.com. And so, yeah, Make My Trip has got a very strong sort of market position in Indian online travel. Why is that interesting? Well, firstly, online travel penetration in India is still at fairly low levels. So on a sort of ballpark basis, international air travel online penetration is around about 30%, and other emerging market countries are closer to sort of 60% plus. And so that penetration has the potential to double at least. And then the spending per capita also has a very long runway to go. So the amount of the Indian population that travels, the spending per capita is at very depressed levels, even relative to countries like China. There's the scope for that spend to increase multiple fold over the coming years. So you have that increasing spending per capita, the increase in online penetration, and Make My Trip benefits from all of this. You could also own one of the sort of the airline operators, but that sector is a bit more sort of boom and bust, and we see an online travel agency as a much more sort of stable way to get exposure to that very sort of long-term penetration story.
Obviously, we've just had Donald Trump back for a second time as US president. He's been talking a lot about tariffs on various parts of the world, obviously with China. I mean, just generally from an emerging markets investment perspective, is he good or bad for stocks, in the EM world?
Yeah, I think whenever there's a big political change in the US, it has implications both positive and negative for emerging markets, and there will be inevitably some companies and some countries and sectors that benefit, and some that lose out from a difference in US policy. And so I think the first thing to mention is that Trump is notably very pro-growth, and so I think it's a fairly consensual view that he'll be positive for the growth outlook in the US, and that will have a number of sort of beneficiaries in emerging markets for countries that are trading partners with the US, and it can lead to increased investment in a lot of these countries. And so there will definitely be winners as a result of the election result in the US. But also there are, as you mentioned, a lot of headlines around tariffs, and so there will be winners and losers from the tariff announcements as well. And so what our job is to do is to look at company by company who are going to be the winners and losers. And so there might be a company that has localized its manufacturing and its supply chain in the US, but it's an emerging market company, and they could be a beneficiary from a certain tariff backdrop. And so really we look at it company by company and try and identify the winners and losers from the outcoming policy announcements.
Where do you stand on China? I mean, I presume you have exposure. I thought most emerging market sort of funds and trusts would have something, in that country. Is that the case? And do you think actually that despite Trump coming in and perhaps raising the risks and uncertainty for China, there's still a good opportunity longer term there?
Absolutely. It's I think there's still fantastic opportunities in China. If you look at a lot of the world's innovation, it comes out of China. And so one of the holdings that we have, a company called Cattle, is by far the leading battery manufacturer, and their technology is driving the sort of world's innovation in batteries. And so there are a number of key sort of structural winners in China, and a lot of money being invested into research and development. More generally, I'd put China into sort of three broad buckets. You have the heavy industrial sectors in China, whether it be steel, cement, automotives, petrochemicals, that sort of thing. Then you have the financials, particularly the banks, and then there's the sort of more consumer-facing sectors. And we definitely have a strong preference for consumer stocks in China, and the reason for that is that the country is sort of pivoting away from its sort of real estate heavy investment stage and more towards consumption. And that's been very clear from the sort of recent stimulus announcements, which have quite a different makeup to what we've seen from China's stimulus packages in the past. Very clearly not being directed at the property sector, but more towards a recovery or incentivizing a recovery in consumption. And that's why we have that strong preference for the consumer sector. There's a lot of overcapacity in a number of industries still, as I mentioned, and so that's why we've sort of stuck away from those heavier industrial sectors. And then finally, on the banks, you've seen a big cut in interest rates, which is in any market typically negative for the banking sector. It squeezes the banking system's profit margins, and at the same time, the struggles that we've seen in the property sector can have an impact on asset quality in the financial space as well. So we're a bit more cautious on the financial sector and the industrial sector, and much more positive on the consumer outlook in China.
Well, Chris Tennant from Fidelity Emerging Markets, thanks ever so much for coming on the podcast. It's been brilliant to have you on.
Thanks for your time, Dan. Appreciate it.
That was Chris Tennant there, co-portfolio manager of the Fidelity Emerging Markets Fund. And that is all for this week's episode of the AJ Bell Money and Markets podcast. Don't forget to subscribe wherever you get your podcasts and leave us a review if you enjoyed the show. As always, if you have any questions or topics you'd like us to cover, send us an email to podcast@ajbell.co.uk. Thanks for listening, and we will see you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.